Window oscillators and overlay indicators. 8.1 Defining indicators and oscillators. Classification of oscillators and indicators. Indicators is subdivided into two categories. 1. Overlay indicators. Overlay indicators are plotted on the same chart as price action as well as window oscillator action. They represent barriers to price or window oscillator action, that is, they provide support and resistance at various price and oscillator levels. It should be noted that window oscillator action plotted on the price chart does not represent a valid or meaningful overlay indicator and as such does not provide support and resistance. Conversely, overlay indicators plotted on window oscillator action do represent a valid and meaningful overlay indicator and as such provide a valid barrier to oscillator action. For example, an overlay indicator such as a Bollinger Band plotted on an RSI window-based oscillator would indicate levels of overbought and oversold in the RSI. Finally, there are four types of overlay indicators, namely A. Numerically based overlays. These overlays forecast future price barrier levels mathematically. For example, a Fibonacci upside price target based on 161.8% expansion of the range AB from C is calculated as C plus 1.618 AB. B. Horizontally based overlays. These overlays forecast future price barrier levels based on prior resistance and support levels. Forecasts are therefore independent of time, that is, they do not vary with the passing of time. Price gaps, rising and falling windows are also a horizontal overlay indicator of potential future support and resistance. Although such forecasted reaction price levels do not vary with time, it is important to note that such reaction levels may still be invalidated, especially when breached a significant number of times. It should be noted that some numerically based indicators, such as Fibonacci ratio and Gantt square of 9 price projections, may also be classified as horizontally based overlays, unlike numerically based indicators such as moving averages and Bollinger Bands. C. Geometrically based overlays. These overlays forecast future price barrier levels via the drawing of diagonal trend lines or lines that are projected from particular peaks and troughs, also referred to as price inflection points. Since they are diagonal, forecasts of potential barrier levels based on these overlays will vary over time, and the forecast of potential barrier levels will depend on when price tests these overlays. In other words, the forecasts of potential future price barrier levels depend on the geometry of the barrier created. D. Algorithmically based overlays. These overlays forecast future price barrier or breakout levels based on a specific sequence of bar or candlestick action. Some examples include 2-bar breakouts, Guppi's count backline, and DMARC's TD sequential indicator. 2. Window oscillators. These are mathematically derived indicators that are normally based on open high-low close OHLC data, volume, and open interest. There are two types of window oscillators, namely A. Bounded oscillators. Values or readings of window oscillators that range from 0 to 100%. We say that the oscillator has been normalized. The advantage of using a bounded oscillator is that it provides a meaningful way of comparing relative levels of overextension, that is, relative levels of overbought and oversold, between different stocks or markets over the same number of periods. B. Unbounded oscillators. The values or readings of unbounded window oscillators have no upper or lower limit. These window oscillators are therefore referred to as being semi-bounded. The main advantage of employing an unbounded oscillator is that it provides historical levels of overbought and oversold. An unbounded window oscillator may sometimes be converted into a bounded window oscillator via normalization, confining the range of window oscillator action between 0 and 100%. Normalization will always convert a point-based oscillator, e.g., MACD, momentum, key, ATR, ADX, etc., into a percentage-scaled oscillator, ranging between 0 and 100%. It should be noted that some practitioners refer to unbounded oscillators as window indicators, rather than oscillators. This is mainly due to the fact that an unbounded oscillator need not actually revert back to its central or equilibrium value. Values can rise or fall indefinitely with no indication of whether they will revert to equilibrium levels. As such, many practitioners prefer to use the term indicator, as many unbounded oscillators tend to not oscillate around their equilibrium levels but rather trend in one or the other direction. Unbounded oscillators that tend to trend include those that employ a net running or cumulative total of all past values, such as the net advance decline line, OBV, and so on. Chart scale sensitivity and invariance. Chart scaling only affects indicators that are geometrically based. As such, it does not affect window oscillators, as the values of all window oscillators are numerically determined, that is, mathematically calculated. Horizontally based indicators like support and resistance are also scale invariant. Horizontal overlays are indicators where the forecasted price depends only on the price axis. Time is not an element in its forecast. Unlike support and resistance, trendline forecasts of potential future barrier levels are time dependent on when price tests it. The more time has elapsed, the higher will be the trendline support level when tested by price. Trendlines are a form of geometrically based overlay indicators. Unfortunately, geometrically based overlays are the only group of indicators that are not scale invariant. Forecasted prices vary with the scaling employed. For example, two trendlines based on different scaling would forecast different future support and resistance levels. The compression that occurs at higher prices on ratio scale charts affects the angle of all trendlines, which are based on the geometrical relationship between inflection points. Static and dynamic overlay indicators. Finally, a distinction has to be made between static and dynamic overlay indicators and their relationship with numerically, horizontally, geometrically, and algorithmically based overlay indicators. Static overlay indicator forecasts are not dependent on the time element, and as such include all horizontally and algorithmically based overlays, as well as many numerically based overlays. Prior support and resistance levels. Fibonacci projection, retracement, extension, and expansion levels. Gann square of 9 price projection levels. Gann squaring of the high and low price projection levels. Gann's 1/3 and 1/8 retracement levels. Floor traders pivot points support and resistance levels. Reward to risk ratio price target levels. Price targets often represent levels of potential support and resistance. Gartley butterfly pattern based price projection levels. Parabolic SA levels. Chandelier exit based price levels. Horizontal channel based price levels. Dynamic overlay indicator forecasts are dependent on the time element and as such include all geometrically based overlay indicators and some numerically based overlays. The forecasted price level varies over time. The exact forecasted price reaction level is only known once price tests or is in proximity to the overlay. Some dynamic overlays include Bollinger Bands, moving averages, moving average bands, Keltner bands, Stark bands, Ichimoku overlays, linear regression bands, Andrews pitchfork, trend lines, rising and falling channels, chart patterns, Wolf waves. 8.2 AEGHT ways to analyze an oscillator. There are 8 basic ways to use a window oscillator to indicate potential buy, bullish, and sell, bearish signals, namely 1. OBOS overextensions. 2. Equilibrium and zero line crossovers. 3. Signal line crossovers. 4. Price oscillator and oscillator divergence. 5. Geometrically based oscillator pattern analysis. 6. Numerically based oscillator pattern analysis. 7. Horizontally based oscillator pattern analysis. 8. Oscillator on oscillator analysis. For a valid price confirmation, price may breach any of the following overlays. Numerically based overlays. Horizontally based overlays. Geometrically based overlays. OBOS overextended levels. Overbought and oversold OBOS levels are indicative of overextensions in price, where a potential reversal in price is expected. 1. For bounded oscillators, overbought is represented as relatively high percentage readings, usually at or above 70 or 80% depending on the oscillator employed. Oversold is represented as relatively low percentage readings, usually at or below 20 or 30% depending on the oscillator employed. 2. For unbounded oscillators, overbought is represented as historical or significant peaks in the oscillator. Oversold is represented as historical or significant troughs in the oscillator. The overbought OB and oversold OS levels for two popular bounded oscillators are defaulted at Stochastics OB 80%, OS 20%. Note that many practitioners upshift these OB/OS levels to OB 90%, OS 30% to account for the upside bias in certain markets or during strong and prolonged uptrends. RSI OB 70%, OS 30%. The OB and OS levels for unbounded oscillators are key oscillator OB +100, OS -100. Note that these values are measures of volatility. This oscillator coincides well with the Bollinger Band 1 standard deviation values. The plus or minus 200 levels also match the Bollinger Band plus or minus 2 standard deviation or sigma bands. Standard deviation oscillator OB +1 or +2 sigma, OS -1 or -2 sigma. Most unbounded oscillators do not have widely accepted levels of overextension. This is because such levels are specific to a particular stock or market historical oscillator action. Note that although the stochastics and RSI have default values for the overbought and oversold levels, our example used the historically significant overbought and oversold levels, which were determined via visual inspection in lieu of the conventional 80 and 20% OB and OS levels respectively. Equilibrium and zero-line crossovers. Another way a window oscillator can indicate buy or sell signals is via the crossing of the equilibrium value, which is represented by any of the following penetrations. 50% level crossing in bounded oscillators. Zero-line crossing in unbounded oscillators. Bounded oscillators fluctuate between 0 and 100% and hence their central or equilibrium value would be at the 50% level. Unbounded oscillators have no upper and lower limits, and as such the zero level would best represent the central or equilibrium level. Signals are indicated as follows. Oscillator crossing above its equilibrium level is a buy, bullish signal. Oscillator crossing below its equilibrium level is a sell, bearish signal. With divergence, higher highs in price may be accompanied by lower highs in the oscillator, causing market participants to initiate shorts or liquidate positions in the market without evidence that price is actually reversing. Figure 8.7 depicts the bounded RSI 50% equilibrium level crossovers generating buy and sell signals on the daily chart of Goldman Sachs Group Inc. Notice that, using the defaulted look-back periods for the RSI and the commodity channel index key, the buy and sell signals generated by both oscillators are nearly identical. The unbounded key generated signals via its zero-level crossing. Many novice traders make the mistake of putting on a combination of price-based momentum oscillators. Key, stochastics, ROC, rate of change, the MACD, and the MUM, momentum oscillators all at the same time. This produces an uncanny agreement between all these oscillator signals in generating buy and sell signals, which overwhelms the novice trader and leads him or her into a false sense of confidence, believing that this agreement represents a strong signal. In short, collinearity provides redundant information. Signal line crossovers. Buy and sell signals may also be generated via signal line crossovers. A signal line is a smoothed version of the original oscillator, that is, it is a moving average of the original oscillator values. As such, it will lag the original oscillator action. Signals are indicated as follows. Oscillator crossing above its signal line is a buy, bullish signal. Oscillator crossing below its signal line is a sell, bearish signal. Price oscillator divergence. Divergence between price and the oscillator indicate potential bearish or bullish reversals. Signals are indicated as follows. Standard bullish divergence between price and the oscillator is a bullish setup. Awaiting price confirmation. It is represented by lower troughs in price being accompanied by higher troughs in the oscillator. Standard bearish divergence between price and the oscillator is a bearish setup. Awaiting price confirmation. It is represented by higher peaks in price being accompanied by lower peaks in the oscillator. A potential downside reversal is expected. Reverse bullish divergence between price and the oscillator is a bullish setup. Awaiting price confirmation. It is represented by higher troughs in price being accompanied by lower troughs in the oscillator. A potential upside continuation is expected. Reverse bearish divergence between price and the oscillator is a bearish setup awaiting price confirmation. It is represented by lower peaks in price being accompanied by higher peaks in the oscillator. A potential downside continuation is expected. In figure 8.10, we observe bullish and bearish divergences forecasting potential reversals with uncanny accuracy on the daily GBP/USD chart. Geometrically based oscillator pattern analysis. Buy and sell signals may be derived from applying geometrically based overlay indicators to window oscillators. Overlays that are usually employed include trend lines, channels, chart patterns, apex reactions. Signals are indicated as follows. Oscillator breaching a geometrically based overlay to the upside is a buy bullish signal. Oscillator testing a geometrically based overlay from below is a sell bearish signal. Oscillator breaching a geometrically based overlay to the downside is a sell bearish signal. Oscillator testing a geometrically based overlay from above is a buy bullish signal. See figure 8.12. We see the geometrical overlays on the momentum oscillator generating buy and sell signals upon violation of trend lines and chart patterns on the 30-min chart of the Nikkei 225. We also see a projected channel bottom buy signal. 249. Numerically based oscillator pattern analysis. Just as for geometrically based overlays, buy and sell signals may also be derived from applying numerically based overlay indicators to window oscillators. Overlays that are usually employed include Bollinger Bands, moving averages, moving average bands, Fibonacci levels, linear regression bands. Signals are indicated as follows. Oscillator breaching a numerically based overlay to the upside is a buy bullish signal. Oscillator testing a numerically based overlay from below is a sell bearish signal. Oscillator breaching a numerically based overlay to the downside is a sell bearish signal. Oscillator testing a numerically based overlay from above is a buy bullish signal. Horizontally based oscillator pattern analysis. Buy and sell signals may also be derived from applying horizontally based overlay indicators to window oscillators. Oscillator breaching a resistance level is a buy bullish signal. Oscillator displaying resistance at a prior oscillator resistance level is a sell bearish signal. Oscillator breaching a support level is a sell bearish signal. Oscillator displaying support at a prior oscillator support level is a buy bullish signal. Oscillator on oscillator analysis. Buy and sell signals may also be derived from the interaction between window-based oscillators. Similarly, oscillator on oscillator analysis may also render useful information. 8.3 CYCLA period multiple timber frames and lagging indicators. Oscillator optimization via the dominant half-cycle period. Oscillators and most overlays will normally tend to generate more effective buy and sell signals if they are tuned to the dominant half-cycle period. This will result in the oscillator issuing buy and sell signals based on the wave cycle of interest, and not merely via its default look-back period, which may produce too few or too many signals with respect to the wave cycle traded. There are three ways to calculate the half-cycle look-back period via any of the following formulas, where n is the dominant cycles period. Refer to Chapter 12 for examples of calculations for each formula. n plus 1, 2, and round up if n is even. n 2 plus 1, and round down if n is odd, and 2n plus 3, 4, round to closest integer. For example, assume that we are interested in using the stochastic to generate buy and sell signals. From figure 8.16 we observe that the average dominant cycle period on the daily GBP/USD chart from 2005 to 2007 was on average 75 days, where a new cycle trough was formed at the same wave degree. The half cycle would then be, using the second formula above, 75 halves plus 1 equals 38.5 days. We round this down since n is odd, 75, making the half cycle 38 days. We therefore tune our stochastics look-back period to 38 periods. We see that it tracked and forecasted the cycle troughs perfectly, including troughs during the period after the sample period was taken out of sample data. Note that the standard 14 period oscillator analysis on multiple timeframes (MTF) oscillators and overlays of various timeframes may be plotted on the same chart. For more effective comparison of oscillator action and its relationship to price action, assume that we intend to set up a chart to display the 5-minute, 15-minute, and 1-hour RSI. We use a 5-minute interval chart as our basic chart. We first need to find the multiplying factor MF in order to calculate the look-back periods of the higher timeframe RSIs. MF for a 15 minutes interval chart equals 15 minutes, 5 minutes equals 3. MF for a 60 minutes interval chart equals 60 minutes, 5 minutes equals 12. Lagging indicators. Oscillators, being derived mainly from price, are usually lagging price action. But this does not mean that leading indications are not possible. Divergence is one form of oscillator analysis that is regarded as a leading indicator. Another example of leading indicators is the early reversals that tend to occur in momentum oscillators, normally reversing or slowing down before price. Horizontally and geometrically based overlays are also forms of leading indicators. Not all numerically based overlays are leading indicators. For example, Fibonacci projection, extension, expansion, and retracement are forms of leading indicators, but moving averages are not. Data drop-off effect. The drop-off effect is fairly obvious when an oscillator or overlay drops off an old data point and substitutes it for a new one, preserving the length of the look-back period. Assume that we create a 7-period simple moving average of the following prices: $7, $4, $3, $3, $2, $4, $5. The average would be $28 per 7 equals $4. $4, $3, $3, $2, $4, $5, $4. The new average will now be $3.57. The percentage change is $4 minus $3.75, $4. 100% equals 10.75%. If we now replace the original last price of $7 with $9, the new percentage change will be $30 per 7, $3.57, $30 per 7, 100% equals 16.72%. 8.5 Trend trading using oscillators. In an existing uptrend, a buy signal is represented as oscillator crossing above the equilibrium line, oscillator crossing above its signal line. Oscillator is at oversold or rising back above oversold levels. Oscillator displaying bullish standard or reverse divergence with price. Oscillator violating a chart pattern or trend line to the upside. In an existing downtrend, a sell signal is represented as oscillator crossing below the equilibrium line, oscillator crossing below its signal line. Oscillator is at overbought or declining back below overbought levels. Oscillator displaying bearish standard or reverse divergence with price. Oscillator violating a chart pattern or trend line to the downside. 8.6 Window oscillators. We shall now turn our attention to a few popular indicators, such as ROC, MACD, stochastics, and so on. Momentum tends to weaken and strengthen before price. It is this quality that makes such oscillators effective in forecasting potential trend changes. Unfortunately, momentum oscillators are not very useful during a strong and prolonged up or downtrend, as they tend to remain at overbought and oversold for long periods. During such periods, it would be better to use price overlay. Indicators such as support and resistance, trend lines, moving averages, channels, envelopes, and volatility bands to signal any potential trend change. The use of a trend change indicator such as the average directional index (ADX) may also prove useful in gauging the beginning and end of a trend. ROC tracking momentum via the ratio method. The rate of change oscillator ROC tracks the percent or ratio change in price over N periods. Although the ROC usually uses closing prices, some practitioners also use typical price, mid-price, and weighted close prices. The general ROC formula is ROC latest price periods back equals minus end price in periods back. This may induce the practitioner to believe that the uptrend is starting to weaken. When prices are flat or beginning to flatline, the ROC will decline to zero. For the ROC to remain flat, price needs to be rising at a steady rate. If ROC is rising, this indicates that price is accelerating with respect to prices N periods ago. MUM tracking momentum via the difference method. Momentum can also be tracked using the difference method. Instead of calculating the ratio is in an ROC oscillator, the MUM tracks the price difference over the last N periods. Although the MUM usually uses closing prices, some practitioners also use typical price, mid-price, and weighted close prices. The general MUM formula is MUM equals latest price minus price in periods back. MACD and MACD histogram. Created by Gerald Apple, the MACD stands for Moving Average Convergence. Divergence. The MACD is created by detrending two moving averages with each other and plotting the difference as a window oscillator. MACD equals 12 periodema minus 26 periodema. In figure 8.16, we notice that every time the 12-day EMA tests or crosses the 26-day EMA, the MACD line tests the zero level, refer to the solid vertical arrows. This is because the difference between the two EMAs is zero. Whenever the two EMAs start to diverge, the MACD starts to move away from the zero line, and when they converge, the MACD moves toward its zero level. If the 12-period EMA crosses above the 26-period EMA, the MACD rises above the zero level, and whenever the 12-period EMA crosses below the 26-period EMA, the MACD falls below the zero level. The MACD histogram is a double detrended oscillator. It is the difference between the MACD and its 9-period signal line. The histogram tends to react faster than the MACD by reversing before it. Detrending removes the lag from oscillators, and as such, double detrending creates an even more responsive oscillator. The MACD and its histogram may be analyzed for buy, bullish, and sell, bearish signals using any of the 8 forms of oscillator analysis described in a previous section. In figure 8.20, we see historically overbought levels in the MACD signaling potential tops in the hourly USD JPY. The ATR has the following characteristics. An increase in price volatility increases the value of the ATR. Falling ATR values in an uptrend is a bearish indication. Rising ATR values in an uptrend is a bullish indication. Falling ATR values in a downtrend is a bullish indication. Rising ATR values in a downtrend is a bearish indication. High or extreme values of ATR usually accompany price peaks and troughs in the market. The default look-back period for the fast or raw %K is 14 periods. If we smooth the %K by creating a simple 3-period moving average of it, we call this the fast %T. If we further create a 3-period simple moving average of fast %T, we get the slow %T. In short, the fast %D line is a smoothed version of the raw %K line, and the slow %D line is a double smoothed version of the raw %K line. The %D line is used to determine overbought and oversold levels, 50% level crossovers, divergence, and signal line crossovers. When using the raw %K, the fast %D represents its signal line, and when using the slow %K line, the slow %D becomes its signal line. As far as signal line crossovers are concerned, Whenever the fast %K line crosses above the fast %D signal line, it represents a buy bullish signal. Whenever the fast %K crosses below the slow %D signal line, it represents a sell bearish signal. Whenever the slow %K crosses above the slow %D signal line, it represents a buy bullish signal. Whenever the slow %K crosses below the slow %D signal line, it represents a sell bearish signal. Overbought and oversold levels are defaulted at 80% and 20%, respectively. Figure 8.23 shows a cycle-tuned stochastic tracking the tops and bottoms in silver with uncanny accuracy. Note that the historical overbought and oversold values were used instead of the standard 20 and 80% overextension levels. Extreme levels that the stochastics overextension levels are behaviorally tuned. A higher frequency of alternation between overbought and oversold signals is also an indication of potentially greater short-term participation in the markets. Note that silver reversed at the Fibonacci retracement levels while the oscillator was at overbought. It should be noted that the %K formula represents a normalizing process. It is in fact identical to the RSI normalizing process. Relative Strength Index (RSI), created by Wells Wilder, the RSI tracks the stock's underlying strength in terms of its average gain and loss of over the last 10 periods. Relative strength (RS) is defined as RS equals GL. RSI equals 100 minus 100, 1 plus GL. Rearranging, we get RSI equals 100, G plus L. This is similar to the stochastic normalization process where the maximum value in the numerator will always be equal to or less than the value in the denominator. Wells Wilder used a 14-period lookback and smoothed the RSI data using the Wilder's averaging, which is a form of exponential moving average. The RSI is less volatile than the stochastic action and may be a good replacement for the stochastic in volatile markets. The RSI oscillator may be analyzed for buy bullish and sell bearish signals using any of the 8 forms of oscillator analysis described in a previous section. Overbought and oversold levels are defaulted at 70% and 30% respectively. The reverse is true for sell signals. In figure 8.24, we observe a buy signal as both oscillator readings rose above the oversold level. On the daily chart of Starbucks Corp, the trigger for entry would normally be the high of the candlestick or bar associated with the observed buy signal. 8.7 Overlay indicators. As we have already seen, overlays are classified into 4 categories, namely numerically based overlays, geometrically based overlays, horizontally based overlays, algorithmically based overlays. Price interacts with these overlays, finding support and resistance. The best forms of support and resistance are resistive and supportive clusters or confluences. A concentration of bullish and bearish indicators within a narrow price range will normally result in a strong price barrier. What are flow traders' pivot points? The flow traders' pivot points is a trend following and volatility indicator. It is a numerically based overlay. Depending on the range of the previous day, it will project various levels of resistance R1, R2, R3, etc. and support S1, S2, S3, etc. For the next day, it also projects a pivot point level PP around which the day's action unfolds. To construct these pivot points, first find the previous day's typical price. This represents the next day's pivot level PP. To construct the first pivot support level, we project the difference between the previous day's high and PP downward from the PP price. Similarly, to construct the first pivot resistance level, we project the difference between the previous day's low and PP upward from the PP price. See figure 8.25. We can clearly see why it is called the pivot point. It is around this PP that the previous day's volatility is incorporated into the next day's projections. This will affect the next day's projection levels. Note that if the previous day's close was above its mid price, the new projected levels would all be raised the next day. Hence, it is essentially a trend following overlay indicator. To construct the second pivot support level, we subtract the previous day's range from the PP, and to construct the second pivot resistance level, we add the previous day's range to the PP. To construct the third pivot support level, we subtract the previous day's range from the first support level, and to construct the third pivot resistance level, we add the previous day's range to the first resistance level. A popular way to gauge the day's action is to identify if price has opened below or above the PP. If it has opened below the PP, the current day's prices are expected to drift lower, and if it has opened above the PP, the current day's prices are expected to drift higher. The violation of the second support or resistance levels indicate a strong downtrend or uptrend is in effect, while the third resistance and support levels represent extreme overbought and oversold levels, respectively. If the day is quiet and non-eventful, prices should stay within the first pivot support and resistance levels. See figure 8.28 for price interacting with these pivot point levels. Besides using pivot point levels for initiating entries, many practitioners use the levels as a basis of exiting a position. 8.8 Chapter Summary. In this chapter, we looked at various classifications of indicators and oscillators, and how they apply to price and market action. It is important to note that indicators and oscillators are especially effective in predicting reversals when they coincide with price barriers like support, resistance, trend lines, channel boundaries, and flow traders' pivot levels.